Good morning, everybody, and welcome to this month's IFRS webinar. In this month's webinar, we're looking at old standards that continue to provide challenges. And I've also added to that title, and latest developments. Um, as you know, at the moment, we're dealing with uh, COVID-19 conditions, statistics, information changing more or less on a daily basis. And as we speak, where I am in Melbourne, we're back into lockdown. Um, and as a result of all these rapidly changing um, pieces of information and financial environment, there's also a lot of changes in the accounting world, or resulting changes in the accounting world. And therefore, at BDO, we thought it's a good idea to include in all our monthly webinars all these latest changes. So although we've previously just advised that this session will be around old standards that continue to provide challenges, we've also included these latest developments. So there's actually three ways that you can stay up to date with these changes from our perspective. The one is we try and include latest developments in these monthly webinars. The other way is we include the latest developments in our monthly accounting news, which I know is on my table to be reviewed and finalized hopefully this week. And that's the July edition. And then the third way is we have regular posts on Yammer. So if you are, sorry, not Yammer, regular post on LinkedIn. And we push it out through our BDO Australia LinkedIn page, but also through my personal LinkedIn page. So if you want to stay up to date, the monthly webinars, the monthly accounting news, and the LinkedIn posts. Before we move on, I should also say that unfortunately today I'm not joined by Kevin Frobers, who usually presents these webinars with me. He's actually presenting an impairment webinar at the moment for chartered accountants. Therefore, I'm on my own. Therefore, I just want to check that the sound and everything is working well, because usually if it's not working, Kevin can at least tell me. So if you could just in the chat box, let me know whether you can hear me and all the sound is fine, or in the question box. I'll just see if you could just, everybody can hear me. I just want to make sure everything's good before I go on too far into the webinar. Fantastic. Thank you to those that's responded. That's great. So then I know I can continue. Great. I get some thumbs up, so that's fantastic. I actually don't know how to do that in this webinar, so thank you very much. All right. So that's maybe a bit of an introduction on why I've added the latest developments. If we then go on, I've also started this slide deck by putting in a link to our BDO page where we include all the latest developments around COVID-19 and the impact of COVID-19 on financial reporting. And you can see this is a slightly different screenshot from what I had last month, because we've recently issued a publication on the impact of COVID-19 for lessors. We've also issued some frequently asked questions and some worked examples for lessees and how to apply the rent concession requirements, etc. But that's a link to the page if you want to see what has changed. There's also an invitation to our last virtual IFRS masterclass on the impact of COVID-19 on 30 June financial statements. I think to date we've run nearly 10 of these, and there's another one coming up. So if you want to register for that, please jump on that very quickly. Then I also wanted to flag around LESSEE accounting. As I said, very recently we've issued 2 BDO publications. The top one has got the worked examples, and the second one was just the original amendments as issued by the ISB. And then at the bottom of the slide, the thing that's really got me excited, as you know, BDO are providing a BDO lead, a cloud solution, an IFRS 16 technology solution to various clients. But we also provide the outsourced lease accounting. So we've got a number of people at BDO in our team, and Kevin and my team, just doing lease accounting for a lot of clients. And the tool we use to do that is also obviously BDO Lead. Now, BDO Lead has just been updated to also do or to also apply the practical expedient. And we're very proud of this because the practical expedient was finalized by the International Accounting Standards Board at the end of May. And within a few weeks before the end of June, BDO Australia worked with BDO Germany to update BDO Lead, to roll it out for our clients, to be ready for 30 June reporting. So it's really exciting that our technology solution could change so fast, update so fast, run all the necessary reports, prepare the journals. So if you're looking for any assistance around that, please contact us. Then, as you know, lease accounting, we've got the software as a service, or you can outsource your lease accounting to us. At the moment, we're getting a lot of calls of people saying, listen, 30 June financials, we need to get this done. I've got 200 leases. What do I do? Just pass it on to us. Happy to do that for you. So please reach out. I also want to flag some recent ASIC publications. So I've put in the links to 2 there. The one is a frequently asked questions document that ASIC has issued around COVID-19 implications for financial reporting and audit. And we're actually expecting them to add to those frequently asked questions before the end of this week. So as new things develop and as SIC become aware of new issues, they amend these frequently asked questions. So it's a good resource to look at. And I'll discuss the lessor accounting one today. And then also ASIC has recently released their focuses for financial reporting for 30 June 2020. So 2 really good resources to have a look at. The other thing I wanted to flag is that the AASB are also issuing frequently asked questions. They've recently issued frequently asked questions around remuneration underpayments. They've issued one around impairment of non-financial assets. And then they've also issued one on accounting for government support. So, I think the standard setter, our regulator, everybody, chartered accountants, Australia, New Zealand, everybody really working hard to get all of this information out to everybody in the market. So I'm trying to kind of keep you informed on where the latest information is. And as you know, in our BDO publications and webinars, we always try and take it the next step, make it practical, include examples. So with that long introduction, what we'll be looking at today is we'll start off with lessor accounting. And it's because there's new developments around lessor accounting, but also lessor accounting in IFRS 16 is the same as we had under the old AASB 117. However, COVID has raised a number of questions, so it is an old standard still in a new jacket, but creating some issues. I also want to discuss remuneration underpayments and the document issued by the AASB on how do we account for those. The third thing is really hot, and that is employment entitlements of casual employees. And there's been a recent court decision, a federal court decision at the end of May 2020 that raises some questions and concerns for 30 June 2020 reporting. I would also like to talk about adjusting, non-adjusting events, and in particular, the recent lockdown that I'm experiencing, or a lot of us are experiencing in Melbourne. The next one is ASIC have provided some relief around right of use assets for AFS licensees. Something that's really hot, and it's a really old standard, IAS 20 or AASB 120 around government grants, government assistance for for-profit entities. I would like to touch on that. It's an old standard that we all talk about day and night at the moment. And then I then want to make it a bit practical, and I've included some examples around accounting for government stimulus measures in Australia. Then I would like to talk about share-based payments. Now, IFRS 2 is a complex standard, not often well understood. However, I want to combine that with some COVID-19 related issues. And then finally, and I don't think I'll get to discuss all of this, but I've included there for your benefit. If you are preparing, if you've got a 31 December year end and you have to prepare interim financial statements, 30 June 2020, IAS 34 and COVID, there's some interesting issues. I've included a number of slides. I'm going to aim to discuss it, but I think realistically, I'll only get to share-based payments. But if you're in that position, you've got some slides to have a look at. And again, I've put in a reference there to our BDO model accounts looking at interim financial statements. All right, so it's a lot to cover, so I should get going and get started. All right, so lessor accounting is the first item I want to look at around operating leases. So we've talked about lessee accounting quite a bit, but if we talk about lessor accounting, two documents to look at. There's the ASIC FAQ, and in particular, FAQ 9B have been added a few weeks ago, I think about 2 weeks ago, around lessor accounting. And there's also a BDO publication around lessor accounting with worked examples. So what are some of the key things? Maybe as a bit of an introduction, that IFRS 16, paragraph 81, says that a lessor shall recognize lease payments from operating leases as income on either a straight line basis or another systematic basis, and that the lessor shall apply another systematic basis if that basis is more representative of the pattern in which benefit from the use of the underlying asset is representative. I think what's important to note here that another systematic basis, and to come up with another systematic basis to recognize your operating lease income is not something that I've seen in practice. In practice, all lessors use a straight line basis. And we have explored whether there is an opportunity to use another systematic basis now with COVID-19. For example, if a lessor doesn't have access to a property, or they're not allowed to open their retail store, or tenants are not allowed to open their stores, etc. And we couldn't come up with a justification. So I think it's important when we look at paragraph 81, first of all, that a lessor shall recognize lease payments from operating leases as income on a straight line basis. That's what we see in practice. And what that would mean is the journal entry that would be processed every month by our lessors would be I'll debit or lease receivable and I'll credit rental income. And then once we actually receive the cash, we'll say debit cash, credit that lease receivable. It's a straight lined rental income that would be booked. Now, the question really that we're dealing with here is, should a lessor continue to recognize rental income if the lessor expects to provide a rent concession to their tenant or the lessee? Now, in the Australian context, this is really important because when we look at 30 June 2020 financials of lessors, we could have a scenario that, based on the federal legislation and the various code, our lessors are currently negotiating a rent concessions with lessees. Maybe lessees have not paid them anything, let's say in April, May, and June. They haven't signed on the dotted line yet, but they're still thinking about it. And we think there's an expectation, and the lessor actually expects to provide a rent concession or rent relief to many of their tenants in respect of April, May, June, and potentially also in respect of future amounts. So how do we account for those? All right, so should a lessor continue to recognize rental income for April, May, and June to be included in 30 June financials if they expect to provide a rent concession to their tenant or the lessee? So that's a critical question, and it's a hot question in Australia. And I think if you look at this carefully, the important thing to note is that the effective date of a lease modification, and this rent concession from a lessor perspective, remember there's no practical expedient for the lessor. If the lessor provides this rent concession, it would be a modification. So the effective date of this lease modification is when agreement has been reached between the lessor and the lessee. And the date of the lease modification is not the date that the non-binding or the non-mandatory legislation is issued by federal government in Australia, or when the various regulations or the codes were issued by the states. So that's not the date of the lease modification. Also, there's no need to account for the following at reporting date, 30 June 2020. So, if we expect to grant a rent concession, we don't take that into account. If we're still negotiating a rent concession as a lessor, not taking it account. If it's not clear whether we'll agree it, there's still things we have to do before we finalize the rent concession. Maybe we're not sure about the outcome of arbitration or a court case on whether we'll have to provide a rent concession. And even if the lessor has legal advice that indicates that the court will uphold the need for the lessor to provide a rent concession to an eligible lessee, we would not take it into account. You would only take this rent concession lease modification into account for lessor accounting if it's actually been agreed and signed on the dotted line by the lessor and the lessee. So I think that's the first thing. Now, the next question then is, and my understanding is this is very common, it was next to impossible for lessors to sign on the dotted line with all lessees and all tenants before 30 June. So what if nothing's been agreed by 30 June 2020? What do the lessors do now? Because lessors could be a little bit concerned. They'll be booking rental income and they'll be booking lease receivables, but they know they're not going to receive that money. So should they be booking the rental income? Should they be booking the lease receivable? After analysis, you would apply IFRS 16, the lessor would apply IFRS 16 and continue to recognize the lease receivable and the rental income. So, as we've said, under IFRS 16 paragraph 81, the straight line rental income, continue with that. Then the lessor will determine the expected credit loss in terms of IFRS 9. So initially, a number of people were concerned about that. They said, can we apply IFRS 9 if there's been no change in the credit risk associated with our tenants? And in the end, IFRS 9 paragraph 5.4.4 states, an entity shall directly reduce the gross carrying amount of a financial asset, for example, a lease receivable, when the entity has no reasonable expectations of recovering a financial asset in its entirety or a portion thereof. Therefore, we continue to apply IFRS 16. We book the lease receivable, we book the rental income. Then we go to IFRS 9, and in particular, paragraph 5.4.4, and we say, what is our expected credit loss? And this expected credit loss is not just linked to credit risk, it's actually linked. If we look at paragraph 5.4.4, about expectations of recovering an asset or not. And then it comes down, do we as a lessor have realistic and supportable assumptions in respect of our expected credit losses? So we apply 16 and then we apply 9. Now, next question is, what if after 30 June and before the financials are signed, the rent concessions are agreed between the lessor and the lessee? So even if it happened on the 1st of July, we would say it's a non-adjusting event. So we would say once we sign on the dotted line, we'll account for it. Before it's happened, we'll continue with 16, we'll look at expected credit losses, and then if we move after year end and we sign on the dotted line, what do we do now? And here we've got a distinction. Let's assume it's signed on the 1st of July. There's a distinction between a retrospective waiver or forgiveness and a prospective waiver or adjustment or concession. What do I mean by that? If on the 1st of July we say, listen, we had in our books a lease receivable and we had rental income, and now we decide to waive that, so you don't have to pay us whatever we had in our books in April, May, and June, one would compare whether that amount waived is similar to what we've booked in our expected credit loss. And if it's similar, on 1 July, there would be no impact on our P&L. However, if the amount that we waive is more than the amount that we included in ECL, there will be an immediate impact on profit and loss on the 1st of July when this is agreed. And that impact on the profit and loss will not be spread over the remaining period of the lease. However, if on the 1st of July we waive or we adjust future payments, so July, August, September, so prospectively, it would be treated as a lease modification. So we'll apply IFRS 16 paragraph 87. And that would mean that reduction in the payments will now be spread to P&L over the remaining lease period. Why is that? Because we would say at the date that we have the modification, what are the new remaining lease payments? What are the remaining lease term? And work out an even or straight-lined operating lease income again. So from a lessor perspective, we would distinguish between retrospective forgiveness or waivers versus prospective adjustments. And what I've just discussed has also been captured in the ASIC FAQ 9B, but I wanted to talk that through because there's some difficult things in there. For lessors, we've previously I just want to have a look. Somebody has asked me the presentation is stuck. They can't see it. Is there anybody else having that problem? I thought I'm now on a yellow slide which says remuneration under payments. Is that where everybody are? Oh, yeah, no, that's good. Sorry, I've just looked at a question. Fantastic. Thank you very much. All right. So initially, the new IFRS 16 has not created issues really for lessors because it was just the old requirements of AASB 117 in a new wrapper. However, when we now look at COVID, there's a lot of questions around lessor accounting. So if you need guidance, please contact us. The next one that I want to look at is remuneration underpayments. Now, this is one that I think we all have been reading about a lot in the press, where entities come out and say, we've done a review and we realize that we've got made certain underpayments. And the question really is, what is the accounting treatment of those? So the AASB on the 17th of July, so last Friday, issued an FAQ on remuneration underpayments. So a little bit of background on it. So as you know, the underpayment of wages has become a pressing issue in the Australian economy. And at BDO, by the way, we have a team of people who look at this, who help clients to do an assessment of whether they've paid their staff in accordance with all the various awards, etc. Ben Renshaw is the partner in Melbourne, and he heads up that area. So several large businesses have admitted, often inadvertently, underpaying staff. And this FAQ is just really guidance to entities on how do we account for these underpayments. So I've included a link to that as well. So the fact pattern that the FAQ is looking at, just to make a start, it's not always the case, but it gives you some help. So let's say historically an entity has not paid certain employees in full compliance with applicable industry awards. And during the current financial year, the company undertook a review to determine the extent of those shortfalls. And it relates to current and former employees and also superannuation contributions. And the company also made a decision in the current year to compensate all affected employees for the inconvenience of the underpayment that occurred by way of a one-off payment in the amount of $1,500 per employee. Now, this payment is not intended to partially settle the obligation for underpayment, because that amount of the payment shortfall has been calculated separately. But it's really to remediate the employees for any inconvenience. So there's two things happening. The one is we're doing a calculation of what we owe our current and former employees, and the other thing is this payment to compensate them for or remediate them for inconvenience. So really three questions. The first one is, in what years should the payments be recorded? So this is both of them. And the second question, how do I determine whether any prior year payments are material and require a restatement in the financial statements? So, do we have a prior period error or not? And the third question is, what disclosures are required? And what the AASB has tried to do is just provide pointers about things to think about. So if you look at the underpayment restitution, if you look at all the payment shortfalls, they've said if you look at the current around current year service, if the employee have only provided service in the current year, then that underpayment would relate to the current year. It will be booked in the current year, and obviously it has no impact on previous years. However, if a portion of the service were provided by the employee in previous years, so because the employee service was rendered in previous years, I would say in theory, we actually have to go back and fix it in previous years. But as you know, we've got a wonderful thing, and that is materiality. So we'll consider whether the amount that we have to fix in previous years would lead to a material misstatement in the previous year. And if that is the case, we'll have to restate it applying AASB 108. And if it doesn't lead to a material misstatement, then generally we would adjust it in the current year. So you may voluntarily go back and adjust it in the prior year, but if it's not a material restatement in prior years, we can just fix it in the current year. So and there's references here on paragraphs to consider. If you look at the inconvenience payment, the $1,500 per employee, it's not linked, it's a one-off payment. It's not specifically linked to underpayments of a particular year. So you get a flat fee of 1,500, whether you were underpaid in the current year or previous years, etc. It's a once-off compensation, and therefore it would usually be, or it would just be accounted for in the current year. So because it's not linked to a time of service or a period of service. If you look at the second question, and the second question was around, if I just go back and recap on the second one, the second question was on how do I determine whether these prior year payments are material or not? Because as you know, if the underpayment relates to services provided in previous years and it's material, we have to apply AASB 108, and we could have prior period errors. How do we do that? So we have to look at what each employee is entitled to receive based on the past services that they've provided. And usually that is outlined in these applicable industry awards. Now, these industry awards are very difficult, very complex, and often you need assistance to work that out. And now the fact that they were entitled to certain payments in respect of past service would mean, that fact gives rise to a present obligation from a past event. And therefore, it relates to previous years. So if you look at your prior period errors, to determine whether the underpayment is a prior period error, we consider the definition of prior period errors in AASB 108 paragraph 5. And then, a few things to look at. It says the underpayment results from a failure to use reliable information that was historically available. So the applicable industry awards were available, the rates were available. This information could reasonably be expected to have been obtained and taken into account when you prepared and presented prior year financial statements. And therefore, this error could be viewed as an oversight or a misinterpretation of fact, right? So if you look at the requirements in respect of prior period errors, if the amount involved is considered material, then in accordance with paragraph 42, the amount would be recorded as a prior period error retrospectively. So you'll have to go and fix your prior periods. Now, however, if you look at AASB 108, and also recently we've had the new AASB practice statement number 2 around making materiality judgments, information is material if omitting it or misstating it could influence decisions that users make on the basis of financial information about a specific reporting entity. So AASB 101, the materiality definition in AASB 101 also highlights that an assessment is made on the basis of quantitative measures, so the size, and qualitative factors, so nature or a combination of both. So it's, there's additional guidance about materiality. And I think what's important, if we consider all of that, and the bullet point here, the first one is really important. If the entity is in a sector that has been prone to large underpayments or has a large number of employees covered by awards, because these awards are very different for different industry, different type of staff, it's complicated, and do we have the IT systems to do that, etc. It is possible that users will have a reasonable expectation that the entity may be at risk of having such underpayments. Now, in these circumstances, any such underpayments might be considered qualitatively material, regardless of the amounts. Now, I think quite often the amounts are material even before you look at the qualitative aspects. Obviously, it depends on the number of employees, the number of years they've worked for you, etc. But this is an area that entities have to look at very carefully. I mean, it's all over the media. and I think everybody in Australia is aware of the issues, and therefore I would advise clients to definitely have a careful look at this. And if this is an issue, what is the appropriate accounting? So do we just fix it in the current year? And quite often, I would suggest it would be material, whether qualitatively or quantitatively, and therefore we've got prior period errors. Now, and even if the amount involved is not considered material, then it could either be adjusted prospectively in the current period as a change in estimate, or you could still voluntarily use it as account for it as a prior period error. And some entities might want to do that because they don't want to take that hit of the underpayment in the current year. So that's that option as well. And then the last one, if you look at disclosures, now if remuneration shortfall and inconvenience payments are material, regardless of the amounts, the entity should disclose the retrospective restatement of prior period financials under a AASB 101 paragraph 40C. And it includes the nature of the error, the amount of the correction, and each line item that's been affected, also basic and diluted earnings per share, and also the amount of the correction at the beginning of the earliest period presented, so the beginning of the comparative year usually. And then if users of the financial statements might reasonably expect a material remuneration underpayment or inconvenience payment issue, but no underpayments have been made or expected to be identified by the entity, then the reasons for such an assessment might need to be disclosed as well. So if people would expect an issue and we've done our work and there is no issue, one could explain that. So we don't have a provision, we don't have underpayments, we've done all this work and this is why we don't have an issue. So remuneration underpayments, absolutely a big issue. And again, if you need any assistance there, at BDO, we have a team of people who specialize in that. They're not in my IFRS team, but I can put you in contact with them very easily. Now, the next one I said earlier is really hot because it's a real recent development. It's around employment entitlements of casual employees. And when I first became aware of this, I actually went and I spoke to Ben Renshaw, who usually does all this work for clients around the awards. And often, when he helps clients look at potential underpayments, and whether they've paid correctly under the awards, it usually relates to the high risk categories, permanent full-time staff or permanent part-time staff. And, usual casual employees would be like the next layer. However, this one is an interesting one. And I've raised it with him and said, to what extent have you seen it? They have done work in the space, but it's a real recent development, and I'll give it my best shot to explain. And this is that the definition of a casual employee is often unclear, and it's subject to legal interpretation. And the other thing that's the first thing. The second thing that happens is that casuals are often paid a loading, a certain rate per hour that is higher than what permanent staff are being paid to compensate for the lack of, let's say, annual leave or long service leave, compassionate leave, etc. So what that means is employers offset that casual loading that they pay to an employee against the claims that employees could potentially have for permanent entitlements. So the contracts of casuals often specifically state that they are being paid a loading, an increased salary or rate per hour, and therefore they are not entitled to additional employment entitlements. Sometimes it's very clearly even stated in the contract, and that has always been kind of the general understanding anyway. Now, for many years, entities have accepted the above as the correct approach. So we pay you the loading, and we put it in our expense, and the matter is done. And in future, we don't have an obligation to make employment entitlement payments to these casual employees. All right, so that's the starting point. However, in 2018, there was a court decision, and I've put the name in there. They talk about the Skeen decision, which looked at or determined that an employee's pattern or patterns of work are the key determinative factor of their employment status. So, if we've got a casual that works 20 hours a week every week, that would have an impact on whether they're a casual or not. So, as I said right at the start, the whole meaning of a casual employee, is subject to legal interpretation, and this court case has opened it up again. You can't just say somebody's a casual employee if they actually work as if they're a permanent employee. Is my layman's understanding. So that created a bit of a problem and asked some questions. And then in May 2020, there was actually a federal court decision, the Rosato decision, and it, number one, confirmed the 2018 court case, the Skeen ruling around, determining whether an employee is a casual or not. But the more important thing, it also states that employers cannot offset the casual loading paid to an employee against claims for permanent entitlements. Now, currently, apparently, the lawyers or the employers trying to get permission to appeal to this federal court decision. We don't even know whether they've got permission to appeal yet. And I think another matter to note is that the court case, this federal court case, only addressed certain employment entitlements. And the question is, maybe those were the only ones that were relevant or not. So to what extent does the court case apply to all employment entitlements, or does it only apply to the 4, etc.? And also, there's also a requirement that if you have to look at employment entitlements, you have to go back to all employees that worked for you over the last 6 years. And I'm saying 6 or 7 years on my slide because there's a record keeping obligation for 7 years. So is it 6, is it 7 years? So as you can see from this May 2020 federal court decision, it opens up a whole new problem around whether if an entity has casual employees, and if an entity had casual employees over the last 6 or 7 years. The first question, at 30 June 2020, does the entity have a liability to make these employment entitlement payments to these people, or is it only a contingent liability? And then the next thing, if it is a liability, does the entity have a prior period error, or is it a change in estimate? Now, let's look at them one by one. The first thing is I've put in there for you an article from the AFR, or a link to an article from the AFR. On the 20th of May, it was published around the May 2020 decision, and it explains it. You can also go and look for the original Skeen decision. So there's some information. So my question to you would be, and this is why I wanted to put it in the webinar, is if your entity have casual employees or had casual employees over the last 6 or 7 years, I think this is something to think about, especially have a lot of it, because then it could be material again. And the other thing is, if you look at COVID-19, if employees have maybe lost their jobs under COVID-19 conditions, and we know anecdotally, I would say that a lot of casuals have lost employment due to COVID-19. Yes, they might get job seeker payments, etc. Would they now challenge employers to say, by the way, based on this decision, you didn't pay me all my entitlements over the last how many years? So I think this is a real big issue that entities should be aware of. So if we look at the first question, Unfortunately, I don't have all the answers, but at the first question, whether it's a liability or contingent liability, I think it is important to think about and for every entity to assess their exact facts and circumstances and to what extent it's similar to the facts and circumstances to that more recent decision. So, how grey is the definition of casual employee in your organization? Um, do you get a legal opinion? I mean, I can't give you the answer, but a legal opinion, whether your casuals, based on that federal court decision, you have to pay them these entitlements. I mean, there's a lot of issues. How many entitlements? All of the entitlements. A lot of grayness there. um, but definitely the fact that there's been a federal court decision, um, which confirmed a previous decision, kind of, creates a real issue whether we should book a liability at 30 June 2020. And if you combine this with what we've talked about employment underpayments, I think this is a big risk. Why would some people maybe say it's a contingent liability? Maybe because their facts and circumstances are quite different to what was in the court case, and maybe a legal opinion says it wouldn't impact you. I wouldn't want us to argue that we can't reliably measure it. Reliably measuring is not an excuse to not book a liability. You just do the best you can, a good, honest attempt, and you book that. So, I think entities will have to do a lot of work to establish whether they've got a liability or not at 30 June in respect of these casuals. And then the other thing is, if you've got a liability, would it be a prior period error because these people, these casuals have worked for you over the last 6-7 years? Or could we potentially argue it's a change in estimate because it's new court decision? And I made the point earlier that, in the past, this was generally accepted practice, apparently. So I have a lot of sympathy to argue that it's a change in estimate in the current year and not a prior period error, because it's based on the latest federal court decision. But definitely, I would recommend you to get a legal opinion around this. I think this is a big risk. And especially with the COVID-19 kind of staff losing their jobs, it's a big risk. The next question I thought I'll talk about is around adjusting non-adjusting events. And here, as we know, IAS 10 talks about events after the reporting period. And if we look at 30 June, if new information become available after 30 June, but before we finalize our financials, is it adjusting or not adjusting? And, adjusting, it provides information of circumstances that existed at the end of the reporting period. We'll then go on and adjust the financials. If it's non-adjusting, it provides information of circumstances that arose after the reporting period, and we would not adjust the amounts recognized in our financials. And there's a lot of judgment here. Now, with the COVID situation that's changing so rapidly, we always knew that this is going to throw up a problem, and it has thrown up a problem. And the best example is the Melbourne and Mitchellshire lockdown, and whether that's an adjusting or non-adjusting event. Because I went back, I think there's so much media around this. 30 June, there was an announcement of the lockdown of the coronavirus hotspots in Melbourne. And then on the 7th of July, there was an announcement that Melbourne will return to lockdown. So that is the whole of Melbourne and Mitchellshire. And we know it's now also spreading in country Victoria, and some limited, and some spreading in New South Wales as well. But if we think about it a bit more, that 7 July lockdown announcement, is that adjusting or non-adjusting? It's clearly after 30 June. But does it confirm information that was already out there and conditions that existed at 30 June? I looked at the DHHS, Department of Health and Human Services website last night, and I looked at the coronavirus numbers as at 30 June, and I've put the link in there, and there was already, a significant increase in the numbers on a daily basis. Now, for somebody living in Melbourne, I know we all talked about lockdown is coming. We knew lockdown was coming. They locked down the hotspots, and looking at the numbers, how it was just climbing and climbing, we knew we'll be back in full lockdown very soon. So, I don't think we can. I think if a client assesses that this is an adjusting event, absolutely, I could see that. I think it's hard to argue that it's a non-adjusting event. We are expecting ASIC to come up with an FAQ addressing this before the end of the week. However, I want to focus really on the consequences of this. A lot of entities, when they're looking at valuations and impairment testing, so valuations of a number of assets and impairment testing of assets, they often build in different scenarios. Maybe a very conservative scenario of full lockdown and another scenario of, lockdown, let's say just partial lockdown, etc. I think when you look at those various scenarios at 30 June, and it has to be done at 30 June, and ECL calcs have to be done at 30 June, I think the probability of a Melbourne lockdown should be very high, based on what happened on the 7th of July and based on the increasing numbers that already existed at 30 June. So whether you are treated as adjusting or non-adjusting in the end is not critical. It's the fact that when you assign your probabilities to all your different models and scenarios, it should be a very high probability of Melbourne lockdown. Doesn't matter how you look at it. And that's why I want to focus on the consequence of this lockdown. And now the other probabilities that one would expect clients to factor into impairment calculations in ECLs is the length of the lockdown. Will this just be a lockdown for 6 weeks? Personally, I don't think so. I'm trying to get my children ready that it's not going to be just 6 weeks, and myself most of all. So it's, the length of the lockdown. Is it a lockdown for 6 weeks, 12 weeks till the end of the year, etc.? How's this going to work? Is it just a lockdown of Melbourne? Will there be lockdown in Sydney or rural Victoria as well? So think carefully about the probabilities you assign. And remember, you assign the probabilities at 30 June. You shouldn't use hindsight. But if I look at this announcement on 7 July, I would argue it's not really using hindsight. We realistically expected it at 30 June. So that's just something to think about. The other one is the right of use assets and AFS licensees. Now, we know that ASIC earlier came out and said that, right of use assets should be treated as intangible assets by AFS licensees, and that created an issue for AFS licensees around their financial resource requirement. And we know that, the ASX and BDO and a number of entities, APRA, the Basel Committee have said you don't automatically treat right of use assets as intangible assets. You look through the asset, the right of use asset, to the underlying item. And if the underlying item is the right to use property, we would treat it as tangible. So ASIC has come out very recently, and I've got a link to the publication there, which they call a no action position to allow right of use assets to count in satisfying an AFS licensee requirement. So it's a no action position. That's good news for AFS licensees. So I just wanted to communicate that, because we've previously talked extensively about this ASIC position. If we move on to government assistance, IAS 20. Now, because governments across the world are really helping, entities are trying to help, this old standard has come to the front. So what is the issue? So the accounting under IFRS depends on the nature of the government assistance, and the resulting accounting is significantly different for when to recognize and how to measure the government assistance. So you really have to look at the nature of the assistance, then go and look at the requirements of IAS 20 very carefully. I also have to say, IAS 20 only applies to for-profit entities. And then in Australia, if you're a not-for-profit entity, you have to look at AASB 1058. Usually it would not be AASB 15 because there would not be sufficiently specific performance obligations that are external and involves the transfer of goods and services. So for profits, we look at IAS 20, and for not-for-profits, AASB 1050. So if you look at the definition of government assistance in paragraph 3, it talks about government assistance is action by government designed to provide an economic benefit specific to an entity or a range of entities qualifying under certain criteria. And government assistance for the purpose of the standard does not include benefits provided only indirectly through action affecting general trading condition. So, that is the provision of infrastructure in development areas or the imposition of trading constraints on competitors. So what are the different types of government assistance that we're seeing? And this is, we've taken a bit of a global view initially, and then I've moved on to the Australian position. So you could have a government grant, there could be income taxes or assistance, government ownership interests, supplies of goods and services, government loans. So government grant, so, it's a transfer of resources in return for past or future compliance with certain conditions within the government grant. We could have, if you look at government loans and guarantees, you could receive loans from government, or government could provide certain guarantees to lenders. And I think that is what we see in Canada and the UK quite a bit. Supplies of goods and services, often if you look at supplies of goods and services, it relates to transactions that cannot be distinguished from normal operations necessarily. There could be government having an ownership interest, so government participation in the ownership of a company, and then income taxes, benefits that may impact taxable profit or the income tax liability. So various different types of assistance that we're seeing. So if we look at, the definition of a government grant, not just assistance, but a government grants are assistance by government in the form of transfers of resources to an entity in return for past or future compliance with certain conditions relating to operating activities of an entity. And they exclude those forms of government assistance which cannot reasonably have a value placed upon them, and transactions with government which cannot be distinguished from normal trading transactions of an entity. All right. So if we look at these definitions of government assistance, government grants to get us going, what are the kind of questions that we should ask when we analyze each type of government grant or assistance? So I thought I'll provide some thought-provoking questions, and then I'll look at some of the things we've seen in Australian. So the first question would be, what assistance is received from government? So entities to look at exactly what's government doing to help us. Second question, is the government assistance provided on market terms? Because if it's on market terms, question 3, if the assistance is provided on market terms, does the assistance meet the definition of a government grant? And if the government assistance is not provided on market terms, is a portion of the assistance a government grant? And if a portion of the assistance is a government grant, who is the beneficiary of this grant? Is the entity acting as a principal, or is the entity just acting as an agent and the actual beneficiary of the government grant is maybe the employee? And then what is the accounting by the beneficiary of the government grant, whoever that is? So if it's the entity, what is the accounting by the entity if the entity is the beneficiary? Or if it's for example an employee, what is the accounting in that situation? So if we take it a little bit from the theory and make it more practical in Australia, I want to discuss 6 that we're commonly seeing in Australia. So obviously JobKeeper, that's just recently been extended and adjusted up to March 2021. There's initial and additional cash flow boosts. There's the instant asset write-offs or backing business incentives. There's the SME loan guarantee scheme, deferral of tax liabilities, and low interest ATO payment plans. And these are the ones that we focused on, and I'm sure there are more. I should say, in my examples, I've kept the fact pattern simple. I'm not trying to come up with any assessment on whether entities are eligible for any of these measures or not. That is for the tax partners to do. I'm trying to come up with a very basic fact pattern and then discussing the accounting treatment of that. So my focus is on the accounting treatment and not eligibility. So if we look at JobKeeper payments, and first of all, I have to say it's 12 o'clock. I'm running horribly over time. If you have to leave, please feel free, obviously. A recording will be made available to all people who registered. And a recording will also be placed on our website. So if you have to go, no problem. You can watch the recording and pick it up after an hour and just watch the end. I would like to continue. I think it's important stuff. So if we look at accounting for government stimulus measures in Australia and in particular JobKeeper payments, it's the $1,500 per fortnight payments for government to eligible employers for eligible employees. Now, the employer must pay eligible employees at least $1,500 per fortnight, even if they usually earn less. And you look at your GST turnover of eligible employers, and the GST turnover must have decreased 30% if their annual global turnover is less than $1 billion, and 50% if annual global turnover is $1 billion or more. So that's just a little bit of information around eligibility of employers. And it's interesting, it refers to GST turnover. It's not revenue under IFRS 15. And then there's special rules for not-for-profits on turnover reduction. And I know these rules are complex and they came out fast and furious as well. And yesterday they've changed it again. In our assessment, employers are acting as principal in this situation. And therefore JobKeeper receipts from the ATO are accounted for in general on a gross basis. So we would say if you're a for-profit entity, you as the employer are taking the risk because you as the employer are making payments to your employees. You might in certain situations be paying them more than you usually pay them because you have to pay them $1,500 a fortnight. On the assumption they are eligible employees and you've done your work to ensure they're eligible, but also on the assumption that you're an eligible employer. And therefore, the employer is taking the risk. If the employees are not eligible or especially if the employer is not found to be eligible, the employer has already made these payments to the employee. And because the employees are taking the risk, we believe they are acting as a principal. And if we then look at IAS 20, we would account for these as government grants because JobKeeper payments are provided by government in return for compliance with conditions relating to operating activities of the entity. So you must continue to employ these eligible employees and you must pay them at least $1,500 per fortnight. Now, the interesting thing is if you look at IAS 20 paragraph 7, it talks about you recognize the receivable for JobKeeper payments when you've got reasonable assurance that the employer will comply with conditions attaching to the grant. So reasonable assurance that we've got an eligible employer, eligible employee, we've paid the $1,500, and the grant will be received. So reasonable assurance. Now, reasonable assurance can be judgmental. You know, some cases might be straightforward, others not. And I think it's important. When I spoke to the tax partners recently, they said, listen, sometimes entities have actually received JobKeeper payments from government, but it's still subject to an audit by the ATO at some stage. So it could be that although an entity has actually received these payments because government's trying to get the money out in the market, at a future time when they're being audited, they might not be entitled to it, and therefore they'll have to repay it. So reasonable assurance is not just have I received it, but would I be able to withstand an audit and keep the money? Now, at 30 June, it's important. You cannot accrue for all future JobKeeper payments that you expect to receive until September, or now actually until March 2021. You can only accrue for payments that you've made to employees up to 30 June 2020. And that is because we don't know what's going to happen to JobKeeper legislation going forward. It's changed yesterday. We don't know whether employees will stay employed and how long they will stay employed. So up to 30 June, you can account for JobKeeper payments up to what you've paid for 30 June, and you think you've got reasonable assurance that you'll receive the money or that you'll be able to keep the money, but not forward looking. So how do we present it now? You'll present it, first of all, you'll ask, what is my for-profit entities accounting policy around government grants? So do I have gross presentation or net presentation? And then whatever your policy is, you would follow that. If you don't have a policy, you can develop a policy, and it's a choice between gross and net. So net would just be we offset the grant that we've received against the salary expense. Gross is we show the government grant separate, we show the salary expense separate. It has no impact on the P&L either way. It's a presentation issue. However, if we go on to not-for-profits, as I said earlier, they wouldn't apply IS 20. They instead apply AASB 1058 because there's no sufficiently specific performance obligations. To continue to employ staff is an internal activity, and therefore it's not sufficiently specific. A performance obligation has to be a transfer of goods or services to an external party. Again, at 30 June, you can't accrue for future JobKeeper payments, similar to what we've discussed for for-profits. But for not-for-profits, it has to be a gross presentation because AASB 1058 does not permit offsetting. The next one I want to look at is accounting for government stimulus measures in Australia, and in particular, the initial cash flow boost. And this is for for-profits and not-for-profits, as well as the additional cash flow boost. Now, very basic understanding, initial cash flow boost is 100% of your pay-as-you-go that you've withheld in the period January to June, you don't have to pay over to the ATO. And the minimum is 10,000 and the maximum is 50,000. So if your pay-as-you-go that you've withheld exceeds 50,000 in that period, you'll have to pay it over. So it is some initial cash flow boost. So you don't have you withheld these amounts when you and instead of paying it over to the ATO, you don't have to. The additional cash flow boost equals your initial cash flow boost. So whatever your initial cash flow boost was, you always also get this additional cash flow boost. So if there would be a cash refund if you've got no BAS liabilities to offset this initial cash flow boost against. And it's available for SMEs with aggregate turnover of less than 50 million. And this is regardless of whether they receive JobKeeper or not. So in our example, we've said our example pay-as-you-go paid from January to June, and it's a quarterly BAS cycle. The pay-as-you-go that was withheld was 10,000 per month, January to March, and then for April to June it was 15,000. So it ends up for that period 75,000. Remember, the initial cash flow boost has a maximum of 50,000, and therefore the additional cash flow boost can also only be 50,000 because it equals whatever your initial cash flow boost was. We'll recognize this as a government grant under IAS 20 for for-profits and IAS 1058 for not-for-profits when the pay-as-you-go is actually withheld. So what does that mean? In January and February and March, we would say you debit your pay-as-you-go liability because I don't have to pay it over, and I credit government grant income every month. Then in April, it's 15,000. So we'll say debit pay-as-you-go liability. I don't have to pay it over, credit my government grant income. And then in May, it's only 5,000 because cumulatively I now have 30 plus 45. And by the end of April, in May, my pay-as-you-go liability is again 15,000, but only 15 of that I get as a government grant. The other 10 I still have to pay. So these are the journals. And then the other interesting thing is in May, when I reach my maximum, when my initial cash flow boost reaches the 50, I now know I'm also entitled to this additional cash flow boost of 50, and therefore at that stage we can say on 31 May, debit the pay-as-you-go liability 50, credit government income 50. So if entities look at their initial cash flow boost between January and June, and whatever they end up for initial cash flow boost at the end of June, at that stage they can also book a government grant income for the additional cash flow boost, although they might only receive it after 30 June, they're now entitled to it, and therefore we can account for it. The other thing that happens is we've got instant asset write-offs. So this applies to assets first used or installed ready for use from 12 March 2020 until 30 June 2020. The threshold have now increased from 30,000 to 150,000. It applies on a per asset basis, so it's a limit of 150,000 per asset. So if the cost of your individual asset is more than 150,000, you'll use the backing business incentive instead, and that's the next one I'll discuss. And the impact of this really is that we've got additional deferred tax liabilities to account for. So what do I mean by that? So let's say you purchase and first uses an asset for $100,000 on the 1st of April 2020. Usually your depreciation under Division 40 is 20% on a straight line basis. And let's say we've got exactly the same for accounting purposes, so 20%. Your accounting depreciation will therefore be the 100,000 at 20% for 3 months, 5,000. Your tax depreciation will be the full 100,000 under this instant asset write-off. And really what we now have is we have a difference between the accounting carrying amount and the tax base at 30 June. We've got assessable temporary differences, and we'll have to book a DTL. So backing business incentive is the one that's applicable. If your assets are more than $150,000, so you can't use the previous incentive. So it's a 15-month investment incentive through to 30 June 2021 to support business investment and stimulate economic growth. It applies to entities with aggregate annual turnover less than 500 million, and they can deduct 50% of the cost of eligible assets when the asset is installed if it's acquired after 12 March 2020 and first used or installed by 30 June 2020. So there's no threshold here. Your asset can cost anything. So as soon as your asset is over 150,000 and you can't use the instant asset write-off, this is a good one to use. And again, similarly, we'll find deferred tax implications here. So, if we've purchased an asset for 10 million and depreciation for tax and accounting is usually 20%, what will happen now, accounting depreciation is the 10 million, 20% for 3 months. Your tax depreciation will be, you get 5 million immediately, tax depreciation, and the remaining 5 million will be 20% over 3 months. And therefore, we've got a difference between the accounting carrying amount and the tax base. And again, we have a deferred tax liability. Another thing that we see is a government, SME loan guarantee scheme. So the coronavirus MS small medium entities guarantee scheme set up by government to support SMEs to get access to working capital. So government guarantees 50% of these new loans issued. The maximum loan amount is 250,000, and it's eligible lenders only to SMEs. And the aim is to enhance willingness and the ability of eligible lenders to provide loans to SMEs to get them through this. So an example is an SME obtains a 3-year loan from Bank X of $250,000, let's say at an interest rate of 5%, of which 50% is guaranteed under the SME loan guarantee scheme. The principal is repayable at the end of 3 years, but interest is repayable annually in arrears. And important, the interest rate would have been 7% if the loan was not guaranteed 50% by government. So in this situation, we have two acceptable views. The one view is you apply IAS 20 paragraph 10A by analogy. So you would say the benefit of the loans granted by government at below market rates would be treated as government grant income. So if you look at the 7% versus the 5% and the impact it has on the loan that you recognize, that difference should be a government grant income, because that's really the benefit you're getting. And view 2 is that you apply AASB 120 paragraphs 24 and 29 by analogy. So government grants that relate to assets are deducted at arriving at the carrying amount of the assets, and the income and expenses are being offset. So two alternative views, both coming from AASB 120. In our accounting news, I think this month or possibly next month, we'll have a worked example on those as well. Some other measurements that we're seeing, deferral of ATO payments interest-free, or quarterly reporting, BAS to opt for a monthly cycle so they can get their GST refunds for the June quarter sooner. Or low interest ATO payment plans, and all of these, the impact is really the timing of the payments to the ATO. And if we look at these, because ATO liabilities are not financial liabilities under IAS 32, it's statutory liabilities, so we don't have to account for financing in respect of those. The next section that I've prepared is around share-based payments. And here we're looking at share-based payments where we've got modification of market conditions and maybe the insertion of non-market conditions as a result of COVID-19. Or another question that we often ask is, how do we account for share-based payment expense in periods that employees have been stood down? So maybe they've been stood down, they're still employed by us, but they've been stood down for a number of months. Do we still have to account for the share-based payment expense in that period? So I've got two case studies in here. I think it's time we call it a day. I'll endeavour to include these case studies in next month's webinar. I mean, the webinars that we've scheduled for the next number of months are trying to, you know, if you're a finance team and you're finalising financials, what should you be looking for? And there's one specifically for board members and audit and risk committees. But as I always do, latest developments I'll put in there, and I'll move these IFRS 2 case studies to next month, therefore. The other bit that I didn't get to today is when we look at interim financial statements. So if you've got 30 June interim financial statements and you want to look for disclosures, I've got information on that. I'm going to stop it here, and I want to say thank you very much for persevering with this webinar. I know it's a lengthy one. Unfortunately, so many things happening. If you've got any questions, please contact me. If you've got practical questions that pop up, please let me know. It's important that we know what the practical issues are so we can investigate, so we can share. Thank you very much for joining me. I hope you join me again next month. Please watch out for our accounting news. Watch out my LinkedIn posts. And we hope you are well. Please stay safe, stay sensible. From tonight, we're wearing masks in Melbourne as well. I'm already practicing to get used to it. I'm finding it's not that easy when I walk and I have my glasses on. I can't see where I'm walking, so I now have to wear my contact lenses more regularly. But it's all important. So I hope you stay safe. You take care. Speak soon.